When dealing with accounts receivable, you first must determine what kind of accounting the business uses. If they're cash basis, meaning they recognize the revenue when they receive cash and they recognize expenses when they pay cash, you use the direct write off or the specific write off method for accounts receivable. Under this method, there are no adjusting entries because you really don't match revenues with expenses. Instead, you recognize the revenue when you get the cash and you recognize the expenses when you pay the cash. Think about you and your personal life. This is basically the accounting we use. Thus, when we need to write off a particular account, we know that that particular account is not going to pay us. And at that time, when we read they've gone bankrupt or we just know they're never going to pay us back, we debit bad debt expense and we credit accounts receivable. I know your name and I don't like you anymore. And the amount here is for the actual amount of the account receivable that's being written off. If later that customer decides to pay, then you're going to be debiting accounts receivable, their name, and crediting bad debt expense. In other words, you reverse out the write-off entry. And the amount here is for the amount of cash that you've received. If they say, oh, yeah, I'm going to pay you the whole thing, you don't reinstate or recover the whole thing, only the amount of cash that you receive. And then the second part of that is take their money, debit cash, credit accounts receivable, their name, for the amount of cash received. Notice that it takes two entries to record a recovery or a reinstatement. And the first entry is to get them back on the books, and the second is to match that cash payment with the account receivable. And you really need both entries because if you tried to shortcut it and just debit cash and credit bad debt expense, you would never know who paid you the money. So it's important that you show both entries. Now, for income tax purposes, the direct write-off method is also used. So if you're a corporation on your tax returns, this is the method that you use for accounting for bad debts, not the one that we're going to talk about next. So here's the big chart of how we can do it. If I'm cash basis, or if I'm doing it for tax purposes, we use the specific write-off or the direct write-off method. And notice that we only make this entry when I'm doing the write-off. Alternatively, what we're going to focus most of our time on and what your homework is about is if we're accrual basis. And accrual basis is what all corporations are. And under the accrual basis, corporations recognize their revenue when it is earned, regardless of whether they've gotten the cash or not, and they recognize the expenses associated with those revenues, or they try to match it. So what we always say is expenses follow the revenue. Now, there's different methods. One is based on sales and the other one is based on receivables. And in this particular chart, they've given you two receivable methods, but they're pretty much the same. So either based on a sales approach or a receivable approach, we figure out the estimate, and that estimate of bad debts is recognized in the year of the sale by making an adjusting entry, which is debit bad debt expense and credit the contra asset account known as the allowance for doubtful accounts, uncollectible accounts, or bad debts. And the amount here is an estimate. So let's look at the next slide. And as you can see, here is our adjusting journal entry again. And we make that at the end of every year. And the amount is an estimate based either on a sales approach or on an accounts receivable approach. We don't know their names of the customers who are going to do us wrong, but we know about how much the damage is going to be. When we have a specific write-off, we debit the allowance and we credit accounts receivable. I know your name, I don't like you, and this is for a specific customer account. Notice that the allowance for uncollectible accounts is a current asset account, accounts receivable is a current asset account, so there is no impact on current assets at the time of write-off. Just that's something that's kind of interesting. And then when we look at recoveries, again, it takes two entries. The first one is we got to put them back on the books. Again, these are both current asset accounts. This is only for the amount of the cash that you receive, not for the full account. Ignore this. This is the direct write-off or specific write-off method. And the second thing is take their money. Again, cash and accounts receivable are both current assets. So there is no impact to our current assets when there is a recovery. Again, the amount is for the cash received. So that's kind of an overview of the accounts and the journal entries associated with accounts receivable.